Okay. All right. So let me take you through the syllabus. First of all, this is the syllabus. And let me also explain you. Okay. So basically, we will be following GLAIM materials, right? We will follow GLAIM materials, and you can see the screen is visible to all of you.
Yes, sir.
You can see the screen. Okay. So
Yes.
this is GLAIM material, right? Like for every chapter, they have study notes, right? Let's say this is, for example, chapter number 1, right? So this material coming from GLAIM, clear? And we have prepared our materials also. Our materials are more explanatory and more compiled and summarized, right? So we will be following our materials in the class, but definitely you will get GLAIM materials, also our notes, clear? And let's start your CMA part 1. There are 20 chapters, right? And one second. There are 20 chapters. And the part 1 is called Financial Planning, Performance and Analytics. This is the course name, the part 1. Now, there are 20 chapters. All the chapters have been categorized into 1, 2, 3, 4, 5, 6. So you can say 6 categorized, 6 categories, 20 chapters and 6 categories, right? Now, these are the chapter names. Under category external financial reporting, there are 6 chapters. In cost management category, there are 5 chapters. Right. Then your planning and budgeting category, 3 chapters. Performance measurement, 2 chapters. Internal control, 2 chapters. Technology and analytics, 2 chapters. So total 20 chapters, right? So how to prepare for the exam? What should be your strategy for preparation? Put your focus based on weightage and read the notes. What is weightage? Weightage means the marks, how many questions, how much percentage of questions can come, right? So you can see here, these are the weightages. External financial reporting 15%, planning forecasting 20%, performance management 20%, cost management 15%, internal control 15%, and technology 15%. So total weightage your 100%, right? So who can tell me how many chapters in part 1? How many chapters in part 1?
20.
20 chapters are there. Okay, good. So we will start our session. Chapter number 1, external financial statements, right? In this chapter, we are going to cover concepts of financial accounting, under that, we will cover objectives of general purpose financial reporting. What are the purpose of financial reporting? Next, we'll talk about users of financial statements. Yes, please. Someone said something.
Yes, sir. One question, Rohan this side.
Rohan, yes, tell me.
The passing criteria in the exams.
Okay. Some scoring system, some grade system, they don't declare the score topic wise. But I think I will explain you. I will send a message in the group, the passing criteria. So allow me some time.
Okay.
Okay, Rohan? Yeah.
Okay.
Concepts of financial accounting, features of financial statements, financial statement relationship, accrual basis and going concern and matching concepts. Second topic, concept statement of financial positions and balance sheet, overview, elements, current and non-current, these all in the balance sheet. Then coming income statement and comprehensive income statement. We will discuss about it. So these are the elements, these are the items we are going to cover in income statement. Then coming statement of changes in equity. What is equity? Who can tell me? What is equity? Equity means what? Equity means ownership. Equity means what? Ownership. Equity, yes. So what are the equity transactions that we will check? Statement of changes in equity, statement of return earnings, common and preferred stock, equity transactions, major statement of changes in equity, and limitations of statement of changes in equity. Then we'll speak about statement of cash flows, overview, operating activities, investing and financing activities. There are 3 activities under cash flow. Next, we'll talk about disclosure, direct and indirect method, limitations. Then we'll talk about consolidation accounting. There is no consolidation of financials. This only your theory. Right? Next coming. So we'll start our chapter today. The first topic is concepts of financial accounting. Right? I am sure all of you are in accounting position. Right? All of you know the accounting. Hi, Gohar. Good morning. Okay. Gohar, mute your mic. Right. So we will talk about users of financial statements. The general purpose, right? Just decision making, understanding the return, decision making. So these are the basically the purposes of financial reporting, right? And main question is that who are the users of financials? Financial statements are used by whom? Right? So let me start writing here. Users. Users of financial statements. Right? This slide going to be shared with you. No need to write. Just focus. Observe what I'm writing. Try to understand. Right? Users can be with direct interest. What do we say? with direct interest and with indirect interest, right? So how many types of users? Users with direct interest and indirect interest. Under direct interest, again, we have internal and external users. Internal and external users. Now, who are external users? Investors and suppliers. They are called external users. External users and internal users, right? Now, under internal, who are coming under internal, you can say that internal, your employees. Employees are internal users, employees, and management. Employees and management are internal users, right? Now, why employees need your financials? Why the employees need financial statements? You have been given a job, do accounting, do warehousing, you are a production manager, you are a purchase manager, do your job. Why you want to know the financials of the company? Why you want to see the financials? The purpose is to negotiate salary. To negotiate salary. That's the purpose of employees wishing to look at the financials. And management for what? To assess financial strength. To assess the financial strength of the company and also decision making. Decision making. Clear? You have to really understand the whole concept of financial, the users. Who are the users? Questions can come. Who are external users? Who are internal users? Clear? So that is with direct interest. Now coming with indirect interest, right? Who are they? Indirect interest, they are only external users. External users having indirect interest. But direct interest can be with internal and external. Clear? But external users are having only indirect interest. So external users, under that, who are coming? Your investors. Again, suppliers here. And stock exchange. What is stock exchange? Who can tell me what is stock exchange? The stock market, which is stock exchange, right? Dubai Financial Market, Abu Dhabi Stock Exchange, Bombay Stock Exchange, Cameroon Stock Exchange. We say stock exchange. Stock exchange, why they need your financials? Because you are a public company. Hey, remember, in our CMA, we will not talk about private companies, right? We will only talk about large public companies. Once you become CMA, you join a large company. You don't join a petty small company. So stock exchange is a place where the shares are bought and sold, which is stock exchange. The shares of public companies, MR is a public company. FAB is a public company, right? What is public company? The shares are held by the general public. We say public company, right? Yeah, public company. Then regulators. Regulators also external user. Who are the regulators? Licensing authorities, regulators. Every company is regulated by various authorities. Those authorities like income tax authorities, your FTA also, tax authorities, right? They need your financials. And also advisors. Advisors also need. And stock exchange need for listing. Stock exchange needs your financials for listing purposes. Now regulators, why they need financials? To check compliance. To check what? To check compliance with the regulations, whether your company is complying with the regulations or not. They want to know your financials. They want to see your financials. Clear? Now creditors, suppliers. Why suppliers need your financials? Who can tell me why the suppliers need your financials? To give credit, right? To give credit. You are approaching the supplier for credit lines. You want to purchase on credit. Of course, they would like to see your financials. From the financial position and income statement, they can make out whether you are really worthy of getting credit or not. So they want to assess your financial strength. Then only they can feel comfortable in lending, giving you credit facilities. Clear? So this is all about your users of financials. So users can be external and internal, with direct interest and with indirect interest. You never know. One short question can come, multiple question can come. So you have to get 100 out of 100. Any question coming on the users, you should get full mark. Clear? Next. Okay. Any question on this? Anyone has any question on this? Indu? Rohan? Any question on this?
I
All
have a
clear?
question,
No,
sir.
sir.
Tell me. Rohan, tell me.
This is King.
Hmm.
I'd like to know
Hmm.
why did you say that? I'd like to know more about the listing about the stock exchange.
Okay,
You said
that's very
only
good
we need
question. Yeah.
yeah.
Now, let me take you through what is stock listing. Okay. So, what is stock? First of all, what is stock exchange? Right? Or market where the securities, traded. Traded means bought and sold. Bought and sold is called trading. Trading means buying and selling, right? Any
Yeah.
public company, What is public company? Yeah, Rohan? Yeah, sure. So what is public company? What is public company?
Listed company. Share.
Owners are public. Owners are public. You also can be owner of a public company, right? So public company, they issue shares. They issue shares to public, right? So the shares are listed in exchange so that public can buy and sell. If you want to buy Etisalat shares, what you will do? You will go to stock exchange, right? So there are brokers, stock brokers. You have to have investor account. Let me write also. So what you need? You need investor account and also called trading account. Investor account coming from the market. Market means what? Stock exchange, not gold market. Stock exchange. And trading account coming from brokers, stock brokers. You want to buy and sell stock, you approach any broker and broker will do everything for you. They will get you investor number, they will get you trading account number, and you can start buying and selling. So market is a place where the shares are listed, which can be bought and sold by the shareholder, by the general public. King, is that okay?
Yes, it's okay now, sir.
Right. You will get lot of things coming up in this chapter itself. Don't worry about it. Now, so users of financials, you already understood. See, sometimes I will make some table like this. When I make table like this, it is more clear for you to understand. And of course, you have to read my notes. Okay. Next, let's talk about financial statement, right? So, financial statements. Financial statements. We say full set. Question also can come. The financial statements includes what? Right? Financial statements comprising of, again, financial statements also, let me also explain you what is financial statement. Let's say types of financial statements. One is internal and second is external. Internal financial statements and external financial statements. Internal financials, you can say your MIS, management reports, give me aging analysis, give me inventory report, give me production report, give me sales report. Those are for internal use, internal financials, right? And that is for management decision making. Management decision making. No need to follow GAAP or IFRS. What is GAAP, Isaac? generally accepted accounting principles. IFRS, International Financial Reporting Standard. So internal financials need not follow accounting standard. Clear? Because internal financials only for the decision making. Now your management asking, give me inventory report. What account standard you will follow? So internal financials for management decision making do not have to follow any GAAP or IFRS. Forward looking. What do you say? Forward looking. Right? Management is deciding about the future. So management needs financials for future decision making. Right? We say forward looking. So internal financial statements are forward looking. So they are required to take decisions for the future. Clear? External financials for external and also internal users. Internal users, as you discussed, can be employees, can be management, etc. Right? And external, we discussed previously, stock exchange, suppliers, investors, regulators, advisors. These are called external. So external financials must follow. They must follow GAAP or IFRS standards. Because external means the financials you are publishing the website, in the internet, in the public domain. If you go to Google, you type Itisalat financials, you will get it. But if you type, let's say, financials of any private company, will you find? No. External financials going to the public. Understand? External financials are published in the public domain. Clear? So hence, external financials must follow accounting standards, IFRS or GAAP. What is GAAP? Let's understand. What is GAAP? GAAP, we say local standards. What do we say? Local standards. Every country, they have own GAAP. Rohan, again. Okay, no issue. Come. Right? So every country, they have accounting standard. Indian accounting standard, UAE accounting standard, Canadian accounting standard. Every country, they have their own accounting standard. We say local standards. So the companies operating in UAE, must follow UAE standards. The companies operating in India must follow Indian standards. Clear? So we say local standards. But if any company in UAE and also in Australia, so they should follow UAE standard. They should also follow Australian standards. So that is why they should follow IFRS. So IFRS is called global standards. So if your company following IFRS, it means they don't have to make separate financials for Australia and separate for Sri Lanka, separate for India. Right? So companies have to look, basically local companies, they are following local standards. But now these days, almost all the companies are following global standards. So global standards are globally acceptable. Sometimes Indian standards may not be acceptable in UAE. Local standards could vary, right? But global standards are global. They are global standards. Those standards are acceptable to all the users in the world. No dispute. If your company has complied, your company has prepared financials as per IFRS, so that is, there is no dispute about it. No one will question. Clear? And whether your company is following IFRS or not, it is given in the notes to accounts. Any financials, you will find notes to accounts. In that it is mentioned that the financials have been prepared as per IFRS. Clear? Next. So, internal financials are forward-looking and external historical financials, right? You don't give the projections in the public, you give actual financials, right? So external financials based on the actuals. Audit is based on actuals. Audit is not based on the forecast. Your budget of your company is not audited by auditors. Clear? Budget is not audited. What is audited? Actual financial, historical financials. In 2025, what you did, that's my actual financials. That is audited, not budget for 2026 audited. So budget and forecast are forward looking, and historical means those are the past result. So historical only audited, not the budget. Clear? Next. We'll talk about full financials, full set of financials. Let me write quickly. Full set of financial statements. When I say full set, they are one is income statement, and second other income other comprehensive income, other comprehensive income statement. One is income statement, second is other comprehensive income statement, we say OCI. Number three, balance sheet, we say statement of financial position, balance sheet. Number four, statement of cash flow, right? Number five, statement of changes in equity. And number six, that can be your, let's say, that's your balance sheet, income statement, other comprehensive income statement, statement of changes in equity, and cash flow. So these are the five sets, 1, 2, 3, 4, and 5. These five statements make full set, right? And again, there will be also notes to accounts. Clear? So these are my financials. Okay. Next, let's talk about accrual and cash accounting. what is accrual accounting and what is cash accounting. So let me write quickly.
Sorry, sir.
Go ahead.
Yes, I'd like to have the difference between those full set statements. The difference,
Yeah.
because you just nominate or list them, but you don't explain deeply the difference between them.
Don't worry, King. We are going to do now. Okay.
Okay, sir.
Just
Okay,
hold on
sir.
for some time. Yeah. Yeah, we are
Okay,
going
sir.
to do now. Just give me 5 minutes. Let me finish certain things. This chapter 1 is focusing only on the financial statements. We will have deep understanding. Okay. Now, basis of accounting treatment. Basis of accounting. One is called accrual basis. What do we say? Accrual basis. And second, Vishal, second, cash basis. Accrual basis and cash basis. Very good. Now, GAAP allows accrual basis. Cash basis, no need of GAAP. No need of GAAP. So cash basis accounting does not have to follow any accounting standard. But accrual basis must follow accounting standards. Clear? Now, under accrual basis, what happens? Understand clearly. Revenue, or you can say income. Income or revenue and cost and expenses recorded, right? Whether cash received or not, cash paid or not, does not matter. Does not matter. So what we say? Income recorded when earned, right? Similarly, expenses are recorded when incurred. When incurred. Let's say, for example, now sales can be cash sale and credit sale. Now, are you recording both or not? In your accounting books, you are recording both. That is called accrual. Cash sale means you are getting cash now. Credit sale, you are getting cash later. But still, you are recording. So in the income statement, understand, you have cash sale and also credit sale. So that is called accrual basis. Credit sale, money has not come, but we have delivered the goods. Once we deliver the goods, goods are out of the warehouse, our income is earned. Income is earned. Now, let's say salary. We are in July now. Let's say this income statement, let's for June. and salary of June not paid. Example, but still salary of June will come in the income statement. Expenses incurred, right? Understand? One is income earned, and expenses incurred. Does not matter cash paid or not. Does not matter cash came or not. We have to record the transactions when earned and incurred. That is called accrual basis of accounting. And GAAP, the general accounting principle, they require you to follow accrual concept. We say accounting concept, accounting basis, accrual basis and cash basis. Quickly, next, cash basis. Only cash transactions, only cash transactions are recorded. So no credit sales, no credit purchase. So every, let's say cash paid, cash received, only recorded. Suppose there is a credit sale. So example here, income statement, now credits sale not recorded because money has not come. So under the cash basis of accounting, the transactions only capturing the actual cash payment and actual cash received, right? Can someone tell me, suppose collection, let's say collection, I'm asking the question, collection from receivable, collection from receivable, what entry to pass? You had credit sales, right? When as receivable means your customers, sundry debtors are called receivables. Now they paid you cash. You got cash from the sundry debtors. What entry you will do?
Cash or bank
Cash,
debit to creditor account receivable.
cash or bank debit to
Sunday.
AR, not to sales, to AR, right? And this entry getting under the cash accounting, right? Under the cash basis, basically, you will enter only the cash transaction. Clear? Thank you, Rohan. Next coming. Statement of financial position. First, we'll talk about balance sheet. So now we are going to understand the financials one by one, right? And financials generally coming income statement, then balance sheet. But first we'll talk about balance sheet, right? So balance sheet, who can tell me another name for balance sheet? Another name for balance sheet? Statement of financial position. Statement of financial position. So balance sheet also called position statement. What do we say? Position statement. Balance sheet giving you, have you seen balance sheet? Who has not seen balance sheet? Anyone has not seen balance sheet till now? I'm sure everybody not only has seen, everybody has prepared financials. Yes or no? Good. So balance sheet. Let's talk about elements. elements of balance sheet. One is equity. Hi, King. What I wrote here? The first one, what I wrote here? Hi, King. Hello, King.
Yes,
Hi,
sir.
King. Yeah. What I wrote
Yeah.
here? This one, what I wrote here?
What?
Equity. Equity. Right?
Equity. The meaning?
Equity. Yes, equity.
The meaning is the ownership. You said it
Yes,
is the
ownership.
ownership.
Yes, yes, ownership. Equity means
Yeah.
ownership. Clear?
Yeah.
And second item, liability. Clear? And equity minus liability, sorry, equity plus liability is equal to assets. Right? So basically, one moment, let me show you here. Let's say this is balance sheet. Right? This side, all assets. And left side, equity plus liability. Right? So there are three elements coming in the balance sheet. And this is called equation. Balance sheet equation is equal to assets is equal to equity plus liability. Right? Or equity is equal to assets minus liabilities. These are called balance sheet equations. Right? Now, equity consisting of various elements. Equity means equity that's called shareholders funds. Shareholders funds. So what is another name for equity, Vishal? What is another name for equity? Shareholders funds. Funds means what? No. Funds do not only mean capital. Right? Whatever belongs to the shareholders are called shareholders funds. Also equity. Whatever belongs to the shareholders is called equity or shareholders funds. Now shareholders equity, the components, one is share capital. What do we say? Share capital. Then retained earnings. Retained earnings. These are components of equity. So who can tell me what are the components of equity, Rohan? What are the components of equity?
The shares, share capital, and the reserves and retained earnings.
Yes, retained earnings. Again, you can say reserve surplus. What all belong to the shareholders are called equity. So equity does not mean only share capital. Shareholders funds do not only include capital, also retained earnings. Now, who can tell me? Let us understand. Who can tell me what is called retained earnings? What is called retained earnings? Who can tell me what is called retained earnings? So, let's understand. Retained earnings. So, net profit. Company is having net profit, let's say 20 million dirhams net profit. This net profit for whom? This net profit for whom? For the shareholders. Very good. For the shareholders. Right? And shareholders can be also two types. Shareholders also two types of shareholders. One is preference. What do you say? Preference shares and ordinary shares. So shares can be how many types? Two types. Ordinary shares and preference shares. What is the meaning of preference? Preference means what? Advantage. Some advantage is called preference. So preference shares, they get some advantage, some preference over the ordinary shareholders. Ordinary, we are common man, ordinary, and you are a preferred person. You are having preference shares. So preference shareholders are having some preferences, some advantages. So by virtue of some advantages, the preference share also called debt stock. What do you say? Debt stock, DEBT, also called debt stock, because they have various advantages. We'll discuss coming up, don't worry. Now, ordinary shares. Now, suppose dividend for preference shares may be 2 million, right? So, how much for ordinary? 18 million is for whom? For ordinary shareholders. Now, out of that example, out of that, let's say ordinary dividend, let's say 5 million. This 13 million is called retained earnings. What do you say, Vishal? Retained earnings. Now tell me, this retained earnings for whom? King. Hi, King. The retained earnings, how much? Hi, King. How much retained
For
earnings?
ordinary.
13
It is
million
for
is our.
ordinary.
Yes,
Ordinary.
very good. Very good for ordinary shareholders. Preference shareholders, they got 2 million. Yalla, bye-bye. Right? Whatever left is only for the ordinary. Out of 18 million, 5 million we say payout.
Yeah.
And 13 million we say retention. Now my question says, why retention? See, I will not stick to the book, right? Sometimes I will go beyond, right? Because you are professionals. You should understand, bigger items, not only sticking to the book materials. Now, who can tell me why retention? Why retention?
To
Yes,
use for future growth.
one is expansion, business expansion. And that is the main reason, is your expansion. Clear? Now, suppose you are an investor, want return. Why are you investing? For return. Investments are for return. Clear? Now, return. Let's go beyond, okay? Return consisting of return from shares. Return from shares. If you buy shares, Vishal, you are buying shares. Why? To get return. The returns from shares coming from two sources. One is dividend. What do you say? Dividend. And that is your income. Dividend is income. What else you get from the shares? If you buy shares, you get dividend. What else you get? Appreciation, right? We say capital gain. What do you say? Capital gain. It means what? Your buy price, sell price more than buy price. You bought at 10 and you sold at 13. Capital gain 3. So how much return? Dividend. Let's say dividend you got 2 dirhams. So 2 dirhams dividend, 3 dirhams capital gain. Now total return is 5. Clear or not? Now investor again. Now investor can be again 2 types. Right? Let me write here. Now investor. Right? Investor looking at income and capital gain. Suppose understand you are an investor, right? You want to buy some stocks. Now in your mind, you have to decide whether you want dividend income or capital appreciation. If you want dividend income, you should go for higher payout companies. You should go for high dividend paying companies. Means low retention. So if you want, I want good income, good dividend, you should buy those companies which are paying hefty dividend. The major portion is paid as payout, right? So if you want higher income, you cannot expect capital gain. Capital gain can come from those companies which are budding companies, which are growing companies. Growing companies can only bring you capital gain, market price. When market price goes up, we say capital gain. If any company giving higher payout and lower retention, right? So whatever profit is earned, either something is paid and something is retained. Yes or no? So what is paid is called payout. What is kept is retention. Higher retention means lower payout. Higher payout means lower retention. If retention is higher, means payout is lower. It means company is on growth path. Company going to expand. Means there is capital appreciation opportunities. Any company giving higher payout, low retention, it means the company is mature company. The company has no further expansion scopes. So any company does not have any further expansion scope. They don't have to retain. So most of the dividend they pay out. So you are an investor, you have to decide whether you want income or capital appreciation. If you want income, your objective, you want regular income, that's called objective. If your objective is to earn income, you go for the high dividend paying companies. If your objective is to get capital appreciation, you should go for growing companies. You cannot have both. You cannot have high income and high growth. Growth means capital appreciation. You have to compromise one. You cannot have both. If any company growing, of course, they cannot give you all dividend. They need money for expansion, right? So that was our retained earnings. We'll discuss again. Right? So equity consisting of your share capital plus retained earnings. Then liability, one is loan capital. What do you say? Loan capital. What is loan capital? Bonds issue, right? One more again, let's start. Sources of funds, your company, right? What are the sources of funds? A company can raise money from various sources. What are the sources? First is share capital. You cannot go to bank without your owners putting money, right? So owner's capital is initial capital. Initial capital coming from shareholders, owners, share capital. Then come loan capital. What is loan capital? Hi, King. Hello, King. What is loan capital?
Yes.
What is loan capital?
Loan capital, it is a like a sum of amounts that you receive from external partners. It can be a bank, it can be an individual who gave the money to the organization and which will be returned after sometimes.
Okay, partly okay, but let me explain you. Now, loan capital, then coming loans. Loan capital coming from bonds issue. Coming from bonds issue. Share capital coming from shares issue. Loan example can be partners loan or bank loan, not loan capital, right? Loans can be loan capital when the company issues bonds. Bonds are called loan instrument. Bonds are called what? Loan instrument, also called debt stock. So when company issuing the bonds, it means company raising loan capital, right? Also called borrowed capital. What do we say? Borrowed capital. Borrowings, bank borrowings is not borrowed capital. Understand the concept? Both are liabilities. When company issuing the debt instrument and raising capital, it means loan capital. So issuing the bonds brings you loan capital. But going to bank and getting loans, that is not loan capital. That is mere loan, right? Now coming here, you are a shareholder. So if you buy the shares of that company, you are called shareholder. If you buy the bond, you are called bond holder. In both the cases, you are called investor, right? So who is investor? Investor is the one who is buying the shares or bonds. In both the cases, you are investor, but shareholding, you are called owner. Bond holding, you are called lender. If you are having MR bond, you are called bondholder. If you are having MR shares, you are called shareholder. As a shareholder, you are owner. As a bondholder, you are lender. Now, as a shareholder, what you get? You get dividend. What you get? Dividend. If you are buying the bonds, what you will get? Very good. You will get interest. Clear? If you are buying the shares, you can get dividend. So dividend is called cost of capital. Cost of capital of equity. So dividend is cost of equity capital. Repeat with me. Dividend is cost of equity capital. And interest is cost of loan capital. Clear or not? Now coming to the banks. Your company also has bank loans. Is the bank investor in your company? Your company has taken loans from bank. Is the bank investor in your company? No. Investor means buying the shares and bonds. Bank has not bought your shares and bonds. Bank has mere lent money. Bank is mere creditor. Bank is mere lender. Bank is not investor. So if you take loan from bank, what you pay? You pay interest. Clear? So bondholder and banks both are called creditors, also called lenders. Clear? So whoever giving loan is called lender. We sometimes also say creditor. So what is creditor? What is creditor? Lender. Lender. And we did not know till now. Creditor, we used to think our supplier. Till now, we thought creditor means suppliers. But creditor in a large sense, in the bigger sense, creditor does not include supplier only. Creditor also includes bondholders and banks. Right? Now let's understand what is creditor then. Creditor again can be two types. One is accounts payable. One is accounts payable and the lender. Both are called creditors. So creditors means those who have lent money to the company, lenders, and also suppliers outstanding, accounts payable, suppliers outstanding. Clear or not? Rohan, okay, Gohar. Hi, Gohar. Let me ask you, Nirmal, Rohan, Saranya, Tariq, Indu, Haritha.
Yes,
Hi,
sir.
sir.
So
Hi, sir.
are you
Yeah, get it,
understanding
sir.
or not?
Yes, we are on.
Yeah,
We
sir.
are on.
Yes, sir.
Fully
Yes,
Yes, sir.
understanding.
very
Yeah,
good.
we are following.
Good,
Yeah.
good. Then coming our liability. Liability can be loan capital, that's my bond issue, also can be bank loan, also can be accounts payable. These are my liabilities. Liabilities again also can be long term and short term. Clear? Now coming assets. Assets also can be short term and long term. What is short term? Current assets. What do you say? Current assets. Long term, non-current assets. Short term means within 1 year, long term after 1 year, right? Now, first of all, what is called assets? Assets means what? We have, no, we have done our graduation. The assets, the definition of assets. Rohan, tell me, what is asset?
From which we can generate future economic benefit.
Yes. So assets are resources. What do we say? Assets are resources from which future economic benefit will flow to the company. Mine, this is mine. My asset, mine. What you own, what you own, OWN. Whatever you own are your assets, and those assets going to give you future benefit. So assets are resources. Now coming liabilities. Rohan, thank you. Tell me, what is liability definition? Liability.
Liability, anything payable, like what we have taken.
No. So assets are resources and liabilities are what I wrote here? What I wrote here? Here.
Yes.
What I wrote here? Obligations.
Yes.
So that you owe, OWE. Assets you own, liabilities you owe. Clear? So similarly, liabilities can be current and non-current. Current means payable within 1 year. Non-current, payable after 1 year. Similarly, current assets. Now current assets, okay. Now current assets, let me write here. One is realizable. Second is consumable. And third is usable. And fourth is sellable. So what is realizable is called my AR. Consumable, my raw materials. Usable, my spare parts. Sellable, my inventory. Inventory is sellable. From sundry debtors, I am going to get money, collectibles. These all are called my current assets. Also, you can say usable, also cash. So these are my current assets. Now non-current assets. Non-current assets can be also two types. What are they? Tangible. What do we say? Tangible. We say physical asset. And second, intangible. What is tangible? You can see, touch. Your mobile, your watch, your calculator, your machine, all are called tangible. We say PPE. What do we say? Property, plant, equipment, also called fixed assets. So fixed assets, property, plant, equipment are same, and they include physical long-term assets. Clear? Then coming intangible. Now physical assets, PPE, is subject to depreciation. So physical assets are depreciated. Now intangible assets. Example, you cannot see. Intangible. Your software. then your trademark, patent, franchise fee, right? Your then goodwill. These are called goodwill. Keep it separate. These are called intangibles, right? So intangibles are subject to amortization. What do we say? Subject to amortizations. So intangible assets are amortized and physical assets are depreciated. Depreciation and amortization in the income statement, they appear in one heading: depreciation and amortization. So depreciation is an expense or not? Depreciation, hi Indu, depreciation is an expenses or income? Depreciation is expense or income?
Expense.
Expense, right? Now tell me, what is depreciation? What is depreciation? Decrease in value.
Yeah. The loss of
Decrease
value
in
of
value
a item.
due to wear and tear, right? Due to wear and tear. And physical assets or non-current assets are held for use. See, assets are resources. Simple. Now, long-term assets are what definition? Assets held for use in the production and administration. Plant machinery used for production. Sales team, admin team, your CEO using BMW, those are for administration. Factory building used for production, factory. Your admin building used for admin purposes. So long-term assets, the definitions held for use in the business, either for administration or for production. Clear? So that was all our balance sheet. So I have a balance sheet here just to show you. Very well designed. Yeah, you can see this balance sheet I have prepared here as a template. This balance sheet having all the items, not a single item left over. You have to go through the balance sheet, okay? That's your homework. So let's go further. Balance sheet. Okay, that we discussed already. Now debit credit. Everybody clear or not? Debit credit concept? Clear?
Clear.
Okay. Okay, let me write here. You will fill the blanks, okay? What comes in? Debit. Debit what comes in? Credit what goes out?
Out.
Right? And debit expenses. Credit liabilities. So increase in asset is called debit. Decrease in asset is called credit. Right? Similarly, increase in expenses debit, decrease in expenses credit, increase in income credit, decrease in income debit. Debit all the receivers, debit the receiver, credit the giver, debit what comes in, credit what goes out. Right? Debit all assets, credit all liabilities, debit all expenses and losses, credit all gains and incomes. Simple? Good. Now we'll talk about income statement. So this all current asset, non-current, right? Tangible, intangible, you have to read them. Next. After 5 minutes, we'll go to break. Now we'll talk about income statement. Okay, return earnings you discussed already. Now let us find out how to find out the EPS, earning per share. What is earning per share? Okay, let's calculate what is called earning per share. EPS, earning per share, earning for ordinary share. Remember, EPS is only for the ordinary shares. So how to find out EPS? EPS means how much profit attributable for every ordinary share. That's called earning per share. So who can tell me EPS formula? EPS formula, net profit available for ordinary shareholders divided by number of outstanding shares. Number of outstanding ordinary shares. What is outstanding shares? What is outstanding share? Rohan, what is outstanding shares?
Number of shares like taken by public, issued to public.
No. So one is issued shares. Issued shares, let's say 10 million shares issued to the public, right? Less bought back. Less shares bought back. Company also can buy its shares back from market. Like the company sold to the public, company also can buy it back from public. That's called treasury stock. What do we say? Treasury stock coming up. Treasury stock. So company bought back 2 million shares. This 8 million is called what? Outstanding shares. What do we say? Outstanding share held by public. Public was holding 10 million, but the company bought back 2 million. Only 8 million shares are in the market outstanding. Clear? Now the question says, why bought back? Why company buying the shares? See, if you don't understand logic, that's a problem. Why the company buying the shares back from market? Why? Why treasury stock? Why company buying treasury stock? First is market price is low. Clear? Company share prices are very low. And company knows we have got very good potential next year. Right? Come on, these investors, they don't know. Our price only 8 dirhams. Our price should be 20 dirhams, only 8. So market price is very low. Number 2, company has enough cash. And there is no expansion plan, for example. There is no expansion plan. Company has too much cash. What they will do? They will buy the shares at low price. Clear or not? So treasury stock is buying the shares from the market, then what happens? Now, what happens to treasury stock? What happens to treasury stock? Right? Understand the concept. Can be resold. Can be resold at a later date. And they will get capital gain. Why capital gain? When the company buying back the shares, the outstanding shares now became reduced. Clear? When outstanding shares are reduced, that puts market price, the supply reduced. So market price will increase. When market price increases, same company bought at 8, they will now sell at 12. So from the resale, they will make capital gain. And this buyback, there are a lot of rules and regulations. Understood? Now, there is a period within which they should resell. If they cannot resell the bought back shares within certain period, there can be capital reduction. What do we say? Capital reduction. If they cannot sell, possibly they bought at 8. Now market price maybe 6, for example. There's a time limit. They cannot hold the treasury stock for long period. Within that period, they need approval also from the authorities. Understood? Which are stock market regulators. Let's say SEBI in India, SEBI in USA, ACCA Securities Exchange Commission, and in UAE, Securities Commodity Authority. They are called regulators. You need their permission. There's a time limit. Once you buy back the shares, treasury stock, you have to sell them back within certain period. If you cannot sell, those shares will be permanently cancelled. So your capital was 10 million, now become 8 million. So the 2 million shares will be cancelled permanently. That's called capital reduction. Clear? Next. So EPS you got. Let's say now number of shares 8 million and your profit, let's say profit may be 10 million. Let's say profit, let's say 20 million profit and 8 million shares. So 2.5 is called EPS, right? So EPS formula, and EPS is disclosed in the income statement. Even you have a small company, private company, you will see the financial income statement at the bottom written EPS. So EPS is income statement disclosure. EPS not in the balance sheet. In the income statement, the bottom most item is called EPS. Clear? Next. Now we are going for a break quickly. 11:30 now. We'll go for a break and come back and we'll start all this. Okay. So let me write here break time. So now 11:35. Resume at 11:50 a.m. Okay. We are going for a break now. All right. Hello.
Okay, sir.
Going for a break. Good news. Going for a break. Okay. Thank you.